Focus. Ideate. Innovate. Enable. Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Hello and welcome to the 6th season of Standard Chartered and CNBC-TV18 present India on the Move. I'm your host, Ritu Singh. Now, wealth management is witnessing an unprecedented process of transformation. It has become increasingly transparent, global and modern, in line with the clients that it now serves. Now, the world is changing faster and more fundamentally than ever seen before in history, and therefore, the way wealth is managed and created also needs to change. Demographics, technology and regulation have created a new demand for client-focused, goal-oriented and advisory-driven wealth services. So to take that conversation forward, today we're focusing on the changing paradigms of affluent banking, and joining me today for this panel discussion are Nilesh Shah, the Managing Director at Kotak Mahindra Asset Management Company, Yashraj Irande, MD and Partner at Boston Consulting Group, and Nitin Chengappa, who's the Managing Director, Private Banking, NRI, Affluent and Deposits at Standard Chartered Bank, India. Welcome, gentlemen, and thank you for your time today. Nitin, let me start with you then. In this world of increasingly digital adoption, gamification, increasing number of younger high net worth individuals, how is wealth management changing as an industry?
Digital disruption and digital transformation has been going to a different level recently. And from an affluent player standpoint, it's extremely important for us to adapt to that. The ones who can adapt to it and cater to the changing demands and needs can really be there up there in terms of what they have as an offering to the investor. Democratization is another key word and a trend that we see recently in the marketplace. The consumer has numerous players to choose from. The consumer has numerous products and services available to him, and he today has to take a pick from the entire basket that's available. Recently, we've seen the regulator also playing a very active role here. In the past, we always observed and we noticed that certain offerings were available to high net worth individuals. However, thanks to what the regulator has done recently, the products and services from a wealth management standpoint today has gone not only to an ultra net worth, but also has gone to the entire mass segment as well. Pricing today is at its lowest. Capital ratios have been rationalized, and today low fee products are the name of the game. Look at it from a segment standpoint as well. Earlier, we had a certain client segment that we are catering to. Today, the millennials are taking over. The millennial needs are very, very different, very, very dynamic, very, very demanding. They want everything at their fingertips. They also today are more socially responsible than they ever were. In the affluent space, one has to cater to these needs, one has to know these demands, and therefore you have to be able to adapt to all these requirements. At Standard Chartered Bank, we've tried our best to ensure that we cater to each and every part of these needs that the various segments have and desire from the affluent space in the wealth management space. So you have a segment today which wants a DIY pure digital. You have a segment today which has what I call a quasi-digital, which is assisted come digital. And then you have the traditional relationship management, touch and feel, personal interaction solution as well. So that's the challenge, that's how we're dealing with it, and that's how we need to keep adapting and changing.
Mr. Nilesh Shah, you've been a veteran of this industry for a long time. Tell us, what are some of the most significant differences between the new generation of customers, that is the millennials that Nitin spoke about, compared to what the older generations wanted, and how different are their expectations and behavior from wealth management firms today?
So while there are always exceptions to the rule, on an average, new millennial customer is more knowledgeable, more informed compared to, let's say, traditional customer. They are happy to use technology, whereas the traditional guy, as Nitin mentioned, prefers more personal touch. The new age customer is more willing to take risks. He is happy to move across the product. He is willing to experiment, whereas the traditional guys are more comfortable with time-tested products. In essence, there is a generation change in terms of risk appetite, in terms of service expectations, and in terms of service delivery. This thing will continue to evolve as markets will become more complex, and that's where the role of private banker continues to evolve. He has to cater new millennial with more products, more digital services, at the same time continue to manage or handhold traditional investor with less complex product and more physical touch.
So Yashash, then let me bring this point to you then. What are wealth management firms doing to adopt to these changing needs of the newer generation that Nilesh just outlined for us? And should they be engaging with potential new customers? How should they go about it?
Absolutely. As Nilesh mentioned, in order to engage with this new customer segment, which is in many ways almost born digital or digitally native, the wealth management firms are making, at a very broad level, three very, very distinct changes. The first is that they are now adding more and more asset classes and making them accessible to this new segment. Earlier, it was only the very, very ultra HNIs or family offices who would get access to the alternates or very high yield or structured kind of products. But you will increasingly see that technology has made these asset classes also more increasingly accessible through tokenization, through fragmented ownership structures to the next rung. I wouldn't say it is going down as far as the mass segment, but certainly the next segment of customers, which are the new rich, are certainly getting access. So that's one big change. The second big change is in the engagement model. The amount of information and data that these customers expect from their wealth advisors to be available to them at their fingertips, and the convenience with which they expect to engage with these wealth advisors is completely different. These customers live in an environment where they can order a food from a high-end restaurant on one of the food delivery apps in a jiffy. They can order high-end paintings on apps which are available now, and they expect really the same kind of ease and convenience and quality of experience from their wealth managers. So you will see that the digital assets that these wealth managers are rolling out in the form of apps, in the form of the virtual RMs, in the form of contact center assistance that is provided, that's of a completely different order of magnitude. And the third thing which is changing is also the nature of the RM itself. The RM of the past would be a lot more about walk up at the doorstep, have a cup of coffee, have a deep relationship, understand the inner circle of the client, and then build on top of that relationship. Now that has not gone away, but it has definitely been layered with a new set of tools that are accessible to this RM. These can be calculators, this can be portfolio scanners, this can be product profilers, but there is a lot of tools which are available to the RM, and RMs need to get really conversant and comfortable with using these to the best advantage of their clients.
Nilesh, let me come back to you on that note. Now that we've set that context as well, what are the new service offerings that you're now seeing in the market today that didn't exist a few years back, and new offerings that are specifically designed to cater to these ever-changing needs of the growing base of these young, tech-savvy clients we've been speaking of?
So we have seen evolution from, let's say, mutual fund product to alternate investments and portfolio product, from domestic market to global market, from traditional debt and equity to more structured product, more hybrid product. Essentially, the paradigm of risk and return has evolved from traditional customers to new millennials. One big change which is happening, and which Nitin can probably confirm, the new age customer is also aware about his or her social responsibility. They just don't want to make money. They also want to put that money to right use. So ESG investment will appeal more to new millennial compared to, let's say, traditional customer. And they'll be more interested in finding out CSR opportunity compared to, let's say, traditional customers. So this is all about a completely different paradigm. A traditional investor probably doesn't look for retirement. And as I mentioned, we are talking about average here and not the exception. Whereas the new age person is probably looking at a retirement at 35 or 40. So you really have to change your mindset when dealing with new age customers.
But Nitin, let me take that point across to you as well, something that Nilesh also alluded to. Sustainable investing, investing in ethically sound companies, that does seem to be a trend that is here to stay.
Sustainable investing is a theme, I think, which is new, but is going to stay for a long, long time. At Standard Chartered Bank, we've also got into this theme, and we've been doing a lot of work around this. Today, if you look at the world, the millennial has become a lot more socially responsible than he ever was. He's very aware of what's going on around them. Look at global acceleration towards net zero. Look at climate change issues. Look at environment pollution issues. Look at corporate disclosures that are taking place. All these have a factor on people, individuals, investment objectives and motives today. We recently had a Standard Chartered Bank sustainable investing report that we released. 67% of the respondents said they're willing to take greater risks as long as they gain from these socially investing options that are available. 60% of respondents told us they're willing to shift their existing portfolios to portfolios which offer sustainable options than where they are today. I think that clearly shows where the world is trending, and that clearly shows what investment patterns are today in this age of the affluent players.
Let me also ask you about the trends that you're seeing in NRI investments. Where are they investing currently, and where should they be investing in 2022?
I would broadly classify this into 4 areas. One, the traditional route that everyone normally uses, mutual funds. We've seen people get into the large cap space. However, from an NRI standpoint, there's growing interest today in the small and mid cap because whereas there's higher risk, they also see higher return. We see increasing returns on broking, direct equity. That's become the flavor nowadays. The second theme is about private equity, private placement, largely focused around the ultra net worth, high net worth individuals. They would do it through the fund route, or actually they would look at co-investments in opportunities like tech spaces or other new age businesses that they want to really do. An interesting part in private equity and private placement is the interest that NRIs have in new startups. When I say new startup, it's the small age, small ventures that are getting kicked off. You find people who are willing to put in $100,000, $200,000 because they believe in the concept, they believe in the idea, and they believe they want to be part of the journey. The third aspect that I see NRIs really looking at is in the real estate space. Was quiet for some time. Last 2 years has seen a big offtake in terms of numbers, almost $13 billion of investments that have come in from NRIs. That's almost like an 8% growth over the previous year, huge numbers. The fourth area, which is not related to India, is the offshore investment space. And you see NRIs today willing to take punts in offshore markets where they live. They're looking at real estate opportunities. They're looking at dollar-based investments. So these are 4 areas that I see NRIs really focusing on investing and looking at opportunities that they want to grab today.
Well, hold your thoughts, gentlemen. It is time for us to take a very short break, but stay tuned as we come back on the other side with the interesting conversation lined up.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6. Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Welcome back to the 6th season of Standard Chartered and CNBC-TV18 present India on the Move, where we are discussing the changing paradigms of affluent banking. But Yashraj, let me come to you in terms of diversifying international investments. What sort of demand are you seeing from your affluent customers? What are the trends that are emerging there?
We recently published a global wealth management report, and what's emerging very clearly is that as the average per capita GDP or average disposable or investable surplus per household is growing in India, there is increasing demand for taking exposures to also international assets. There's already the LRS scheme, $250,000 every year, that allows capital to move out, and that's being utilized quite actively. Now there are choices that this capital makes in terms of which destinations they want to go to, and often these destinations are linked with lifestyle decisions that these people end up making, or families end up making, in terms of where they want to either support the education of their children or where they want to have an alternate house or residence and so on. So that's one, and you can imagine that developed economies are obviously a flavor of the season. But then also from an international perspective, just getting access to some of the interesting real estate, as well as in the US markets, particularly if you look at the startups and the Silicon Valley space, where there is access to the opportunity to invest capital in some of the newer ideas, is very, very interesting. And now technology startups in India that allow average Indians to invest in equities abroad. And like sitting here, we could invest in Tesla, Amazon, Google, the FANG stocks as just retail investors. And that was much, much harder to do earlier. And I think that's a pretty big hook in being able to invest in that segment as well when you look at the mass segment in India.
Mr. Shah, also, what about family office trends? Where are they investing? What's emerging there?
On the family offices side, they are clearly evolved a lot. Many promoters have sold businesses. Selling business is no longer a taboo. And that money is getting invested in variety of assets, right from debt, equity, hybrid to structured to real estate to offshore investment. Across the board, family offices are leading the charge. They have what one says a fairly high level of knowledge, fairly high level of risk appetite, and they don't mind even leveraging their portfolio to make investment when necessary. So clearly family offices is one large segment in Indian wealth management space, and they are really evolved professional investors.
Yashraj, democratization is a word that you brought up earlier as well, and we're seeing that even in the offering of services, including from wealth management companies, the access that is available to people today is much better than what we saw earlier. So, how are you retaining customers in this environment? What are some of the best practices you're putting in place to ensure that you're able to retain your customers?
With ease of access to different services and service providers, it's also very easy to switch for a customer. So really retention becomes critical. And in all the analysis and experience that we have on this issue, it boils down to a few very structural things. The first thing is that the retention or stickiness tends to be much higher if you have a larger relationship, which is measured in terms of product per customer or share of wallet. So the idea really is to have a wide enough basket of products available through your platform, so that you can meet as many needs of the customer as possible within, of course, the guardrails of rationality. I mean, certainly I agree with Nilesh's earlier point that we need to be also thoughtful and serious about what kind of products are accessible. But once that's done, the first task is to really create a wider bouquet which meets multiple needs. And the second really boils down to the experience and the quality of service. And there again, going back to where we really started the discussion and the theme today, the use of data, digital and technology is central. For example, people really want to manage their wealth on their time. They don't want to manage their wealth on a bank's time or an advisor's time. So it's not a 9-to-5 job. They may want to do it at 12 in the afternoon on a Sunday. And it's not always possible for humans to show up. So how do you use technology to allow that to happen? And we have seen people who have adopted this better are able to have much stickier and loyal relationships with their customers.
But Nitin, before we wrap up, we've spoken about how investment behaviors are changing between the older generation and the younger generation. What we haven't spoken about is the differences in investment behaviors seen by women compared to men. What are some of the examples, and how have you tailored your offerings to serve women clients better?
Broadly, if you look at men and women, the investment objectives or investment goals are more or less similar. They catered to, I could classify them into 4. Children's future education, higher standard of living, debt-free living, retirement planning, and owning a good house and having some security around it. So this is broadly a common goal that men and women have. But when you come to behavior, then you see a little bit of a difference. A woman investor is known to be a more financially better manager, known to be a lot more systematic when it comes to investment, and is known to be less emotional while taking decisions while investing. And if you look at men as a behavior, you will find them being aggressive risk takers, and therefore you'll see a lot of volatility in their portfolios and how the performance is. At Standard Chartered Bank, we do not differentiate between the two. So we don't have products that is there for a man or a woman. We're agnostic to that. I think what's really important is what is the need? What do they really tend to? For example, if you see a woman normally would give more preference to children, future stability. A man would look at what can I save money for as an alternate career? Where can I invest in if I had more money? I will also do retirement planning. So we would look at the investment goal. We would look at the end result of what a man or woman wants to do and offer products and services accordingly. And it is not about tailor-made for a segment, but it would be for the need that the individual has.
Okay, Mr. Nilesh Shah, I'm just going to close with you with this final question because a lot of the younger generation, which is increasingly the clientele that wealth managers are serving, do tend to have a mind of their own. And Bitcoin, something that you mentioned, cryptocurrencies, does seem to be the flavor among the younger generation. Are there differences in your view and their view, and how do you align the two? Is it sometimes difficult to convince these younger clients?
Undoubtedly, there is always a difference of opinion. But at the end of the day, a manufacturer of a financial product or a relationship manager or a private banker have to do what is right for the client. Our job is to disclose the risk and the return trade-off and then leave it to the customer's discretion as to what kind of return they want and what kind of risk they are willing to assume. To all the young millennials, there is no free lunch. There's no shortcut to success. Your wealth is created by disciplined investment. So stick to the basics of regular investing, long-term investing, and disciplined asset allocation. That will produce as good a result as, let's say, taking huge risk and trying to generate extraordinary return.
All right, with those wise words, we'll wrap up this discussion. That's all the time we have on the show today. A big thank you to all of our guests for joining us on this special discussion and for your time. And thank you to the audience as well for tuning in.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6. Focus. Ideate. Innovate. Enable.